perspectives. I was born and raised in Los Angeles. I went to this fine institute of higher education. I oftentimes, probably 1,000 times, walked past the front of this faculty club, always wondering what went on inside. And now I know. I envision professors surrounded by empty bottles of Chardonnay, but I see it's much more, it's much more serious business, at least today. But then I left California. I spent 20 years, some of that time in New York, most of that time in London, working in and around the investment management industry generally, and private equity funds and hedge funds specifically. So when I moved back to California a couple of years ago, I was genuinely surprised and very, very pleased to see that in the last couple of decades, a thriving alternative community has built up both in Northern California and Southern California. So when I was asked by Steve and then encouraged by Joel to work on the report and also on this conference, it was something that I was very, very pleased to do. I think California is unique in having such a strong manager community and such a strong investor community. The CalPERS and CalSTRS clearly cast a very, very large shadow across institutional investors, but we have a variety of universities, of endowments, of family offices, of other investors that are focused on private equity and hedge funds. So I think it was great to be able to be involved in this project. I think our initial panel really shows the depth of the investor base here in California. It's very rare that you go to a conference such as this and the investor side of the equation is so front and center. But that's very much part of what Steve and Joel and I hope to do with this in the coming months and coming years. So very, very excited to have all of you here. Our second panel takes as its name liability risks for advisors of hedge funds and private equity funds. I really see that as a starting off point. The report and the conference are a product of UCLA Law School and the Lowell Milken Institute. Obviously, legal and regulatory issues are part of what we think, but it weaves through a lot of issues like alignment of interest. We heard a lot about alignment of interest. We heard about fees. Those have within them legal and regulatory issues. So this is not going to be, I hope, a dry presentation of case names and section numbers in regulations, but rather, I hope, a robust discussion of how the rules and regulations and how the concept of legal and regulatory liability actually impact managers and the managers' decisions. We'll also have at various points in time in the next hour a right of rebuttal for members of this panel to comment on things that members of the last panel had to say. I think
and
that
as
will.
a GP, you can guarantee that.
Absolutely, absolutely. And I also want to encourage, we have a little bit more time in this panel than the last panel. I want to encourage anytime any of you have a question, throw a hand up in the air. We will have an assigned period for questions at the end, but if we're talking about carried interest or we're talking about marketing of funds, we're talking about a very particular issue, you have a question, just raise your hand, and we'll be glad to integrate you. One thing I will ask anyone who asks the questions, if we can have your name and where you're from, who you're with, what organization, if any, just so everyone in the room has an idea of who you are and your background. So enough about me. What I want to do is quickly go down the line. I want each of our panelists to give a brief introduction to who they are and what their background is, and then we'll launch into some prepared questions that we've worked through. So let me turn it over to Reena.
Great, thank you. Can everybody hear me okay? All right. So my name is Reena Laljiis. I'm the general counsel of Wilshire Associates. We have been around for about 40 years. We are a consulting private equity, funds management, and analytics firm. My background is I'm a Canadian attorney by training and moved to the U.S. about 5 years ago. And so go Montreal for anybody who's a hockey fan. And I'll turn it over to Jeri.
Thanks. Hi, I'm Jeri Harman. I'm a managing partner and founder of Avanti Mezzanine Partners. We're a Los Angeles-based, lower middle market focused private equity, really mezzanine fund. We're also licensed SBIC, which we can talk more about later. And I've been in the business about 30 years doing this for publicly traded funds and insurance company funds.
I am Charlie Nightingale. I am a senior counsel and I head up the legal group at PAMCO, which is a $9.5 billion fund of hedge funds down in Irvine. I've been there for 5 years, and before, well, I'm a New York lawyer by training, so I was at 2 law firms in New York, Schulte and Davis Polk before joining PAMCO.
I want to kick off by talking about the legal and regulatory changes that we've seen in the last few years radically transformed the landscape for operating in the alternative fund space, in the private fund space. As Joel mentioned in the first panel, and we talk about in our report, there has really been a comprehensive regulatory transformation. As part of moving offices a couple of months ago, I actually uncovered, dated 1998, a compliance guide for an offshore hedge fund that was 14 pages long. Can you imagine that? 14 pages long. I don't think we could get it under 100 pages now. So it's been radically transformed from the early years of the industry to now. So let's talk a little bit, first of all, about dealing with regulators. And I'll start off with a question really for Charlie and Reena. Being registered with the SEC and the CFTC, you're having to deal with higher and higher levels of regulation. How has your relationship with the regulator and also your approach to compliance and staying on the right side of the various lines that has been drawn, how has that changed since Dodd-Frank? I mean, let's put a line in the timeline. Really, Dodd-Frank led to a big transition. In the last 2 or 3 years, how have you felt as authorized, regulated, registered advisors that has changed? Your perspective on those issues has changed.
I guess I'll start. I think before Dodd-Frank, you could look at, depending on the size of your company and the strategies that you're invested in, you could look at compliance as a bit of a part-time job. I mean, to the extent that you weren't registered and you didn't need a CCO, you may not have had a CCO. And if you were registered and you had a CCO, it was very common for the CCO to wear multiple hats, to be the CFO, the COO, et cetera. Post Dodd-Frank, I can't see any organization, with moderate scale, making the CCO a part-time job. It's a full-time job, and it takes a team. I mean, I can tell you, at PAMCO right now, we have, I don't know if I have numbers offhand what we were before Dodd-Frank, but I'll tell you what we are right now. We're 4 lawyers and 3 compliance people, and with almost every regulation that comes out in the U.S. or non-U.S. impacting our business, we take a task force approach. So we'll assign someone from legal, someone from compliance, oftentimes someone from our account management group, portfolio management, oftentimes risk management, IT, operations, to address that regulation and to actually comply with it, because it's like I said, it's a full-time job, and every regulation impacts various aspects of the business.
And you mentioned international. What if you could just ballpark estimate percentage of time between SEC, CFTC, and other international regulatory regimes? What's your breakdown at PAMCO? How do you think, ballpark, you spend your time?
We have a lawyer based in London who spends 50% of his time on legal and 120% of his time on UK compliance and international compliance. I'm glad this is recorded because he can watch this, because he reports to me, and it is true. He spends in each international jurisdiction that we market in, he's looking at the rules. He spends full time on compliance with AIFMD. So for him, it's a huge component of his work. And I'd say if we have an office in London, in Singapore, we market internationally. I would say, like, big picture, we're probably 30% of our resources are spent on international regulation.
That's interesting. Reena, your thoughts?
So I would agree with much of what you said in terms of compliance being a full-time job. What we're seeing, I think, is the regulatory regime becoming more aggressive. I mean, with Mary Jo White coming down with the broken windows, or reiterating the broken windows doctrine, we're seeing the regulators, talking about bringing enforcement staff in normal course reviews. We are seeing more sweeps from the regulators, for example, the mutual fund securities lending sweep that's going on right now. And we have such limited exposure in that area, yet it's taking an inordinate amount of our time to respond to those types of things. Marketing internationally, I think, is becoming incredibly complicated. Our private equity team gets very frustrated at times. They're saying, well, we didn't used to have to deal with these types of issues. It used to be very easy to market overseas. And I don't make the rules, so we just have to understand what they are. Sometimes even understanding what they are is very complicated. AIFMD, for example, trying to get a straight answer from external counsel on AFMD has been very challenging.
It depends on the counsel. I just have to say that.
So Tim's not our counsel in this area, so he's safe there. But trying to get a straight answer in terms of what the regulatory regime is has been really complicated. So it's becoming a bigger and bigger part of our business.
I think that's one thing a lot of managers have to come to grips with, having digested the changes here in the U.S., to then have to break the news to them that, yes, a number of other leading countries around the world have also experienced a global financial crisis, have also suffered from Madoff, and they may well adopt rules like the U.S., but they're not identical. And they differ in very material ways from jurisdiction to jurisdiction. So to follow bad news with more bad news, keeping people up to speed on the international angle is incredibly important. One of the things that we realized as we did research for the private funds report is how internationally oriented aspects of the California private funds market is, and that's encouraging when we look around the room that not only do we have homegrown institutions here that are managing large sums of money for a variety of local and national clients, there's a strong international presence there as well. Regulation is something that many managers, I think we went from a world where pre-Dodd-Frank about 25% of hedge fund managers and private equity fund managers were believed to be registered. That number is now something in the 90 plus, I would assume. But there are still managers who aren't registered. There are a variety of exemptions for funds that operate in particular areas like venture capital and funds that operate below certain size thresholds. And I want to go to Jeri on this one. As a business person, you'll have a couple of different perspectives you'll be able to share with us. But as a business person looking at the regulatory and compliance issues, it'll be great to get your thoughts throughout this panel, but specifically on the outside. The first panel talked about barriers to entry. You're currently on the outside of SEC, CFTC, and other regulation. You're subject to SBIC, so it'd be interesting to hear about that. As you think about expanding your business, with success comes more success and more success. At some point in time, SEC registration will be the right thing for your firm. How do you feel? How do you prepare for those issues now as you're growing your business and experiencing early success?
Okay. That was several questions in one, but that's good. As I mentioned before, we're a licensed SBIC, Small Business Investment Company, so that license comes from the SBA, the federal government. We have a traditional partnership structure, so we have public pension fund, fund of funds, clients, banks, et cetera, as investors, but we also have the SBA as a leverage partner, and they regulate us. So one of the benefits of being an SBIC, besides low cost of capital, is that we are exempt from registration, although we still have to file with the SEC in California, where we're based, as an exempt registrant. So there's also, as you mentioned, an exemption for smaller funds, less than 150 million is the threshold at this point. So we are, so we enjoy that, and that is a benefit. But, that's fund one. Fund two, it's likely to have a non-SBIC component, right? Or you get above the threshold in size as you grow outside of the SBIC. What's interesting is legislation right now, by the way, in Congress to, right now, if you're under 150 million, you're exempt. If you're an SBIC, you're exempt. If you're both, you're not exempt. Mm-hmm. So that's going through to hopefully get approved pretty rapidly, that if anything happens rapidly, to approve both. So that but things like that affect our planning. How are we going to structure our next fund in terms of, or be prepared, to your point, for whatever regulatory compliance regime that we'll be subject to. It doesn't, it's about being aware of it. We're not going to change our plans because suddenly we're, if we're 200 million, instead of 150 outside of the SBIC, that suddenly we're not going to do that because we have to register. Even setting up Fund 1, because we have, plenty of reporting and compliance, burden with the SBA and our LPs, of course, and other rules and regulations that we're subject to anyway. We have a full-time CFO. So we're 9 people. One of them is a full-time CFO who, works with our outside counsel and so forth to make sure we stay between the lines.
Which is not common for firms of your size. That's a great value add.
It's one of the things, I know one of the things we're going to talk about, is diligence and the impact of regulation and diligence, but and I think some of us mentioned in the prior panel, one of the more important things that when we launched our fund back in 2009, very interesting time to raise a fund, and we did it in 2009 and 10. But it became very clear to us that one of the things the LPs even then were looking at was back office, right? Now, part of that's obviously just reporting and being able to have timely and accurate reporting to our LPs, but it was also managing the fund kind of back office, and that includes compliance in whatever form that takes. So we want to start the right way, and that allows us to, for the investor partners, to be able to focus on investing and managing that, and not so much on the administrative and compliance side, although we're certainly involved in that.
Now, as I mentioned before, we've got Reena and Charlie who are on the legal side of the equation, Jeri on the business side. So I want to talk about that interaction and get hopefully a couple of different perspectives on this. Let me start with Reena. As someone on the legal side, when you're dealing with the business side now and you have to say no, you have to say things have changed. As you mentioned, people will say, well, we used to do this all the time. Why can't we do that now? How have you seen kind of post-financial crisis, post-Dodd-Frank, the business side has begun to respect, appreciate, whatever verb we want to put in there, the transformation and the new legal burdens that you're under, that you're having to administer for them? Fully supportive, 100% across the board.
Yeah, one of the things that one of the first attorneys I worked with when I started practicing in this industry said to me is, try and take the word no out of your vocabulary. I think that is really hard to do today. But that being said, the business people, and at Wilshire, I think we're quite lucky. We work within a culture of compliance. We've been around for 40 years. We're relatively conservative, not just in terms of how we approach investing, but in terms of how we approach management of Wilshire. So the business people understand that it's not about, it's about trying to raise a business in the right way, trying to ensure that they're not going to have to wear orange at some point in their life when they're wearing a jumpsuit. But
that's a good way to focus. That is, though, a good image to focus the mind of the managing director who's sitting across from you saying, I really want to do this.
But it is also about trying to get to a place where you understand the regulations, you can work with them on trying to find the right way to move forward in business, and having a team of people, both internal and external, who are focused on that goal. Jeri, I think that's probably what you look for in both external counsel and the people that you're working with internally, correct?
Absolutely. You can't stay between the lines if you don't know what the lines are. Right. I mean, that's our key challenge. And that's why we even have our CFO, who is also our chief compliance officer, is on our investment committee. So even we're talking about deals and structuring and all the things we're doing, he's part of that. And his main charge is to make sure we stay between the lines, and that also we can report things and bring in, have full disclosure and transparency.
And that's probably, Tim, where the biggest frustration, I think, comes from the business people, when they don't know where their lines are. Right. And so that was the AFMD example. Nobody's quite sure where some of these things are going to end up. So being able to help them understand what they can and can't do at a particular point in time, and where the industry is going, so where they're going to be in 5 years and what the rules might look like 5 years from now, is really helpful.
Anytime there's a transitionary period or implementation period, it can be particularly frustrating on the legal side. The question I always hate to get from clients is, well, so-and-so is doing it. I get that question a lot at home from my 11-year-old, but it's frustrating to get it at work as well. And it is, in a transitionary period, well, is competitor X actually doing what this person's telling you they're doing? Were they doing it a year or two ago when the rules were different? Is it a different product or a different service? But you get this, it's a very difficult situation to say no. When you say no and someone comes back to you and says X or Y is out there in the market doing exactly that.
But I was going to say, you mentioned looking forward. I mean, it's one thing to say, are we complying today? Because we're exempt, right, to some things. But we're not exempt to behaving properly and in alignment, all the things that are really the crux of the focus of the SEC in many ways, right? So as we think about what we're doing today, it could impact raising our next fund. As the LPs and if we register, the SEC looks at us. We want to make sure that what we've done in the past is compliant.
Exactly.
Right? So we're going to say, well, we won't do that anymore because now we're not exempt.
And also it's important to understand that, yes, there are very, very detailed rules about do this on this day, file this on that day, always do this, never do that. There are also very general rules of general application that can still capture a lot of mistakes, a lot of problems. So just because you're not registered doesn't mean you can do whatever you want. You still have a lot, Section 206 of the Investment Advisors Act and other laws out there. You still have to be truthful and honest and consistent and operate within your disclosure. I know, Charlie, at PAMCO you see a lot of things, a lot of products, a lot of markets. How would you describe the relationship between your legal side and your business side, and any suggestions you have for optimizing that, minimizing conflict, optimizing cooperation between the two sides?
Yeah, that's a good question. I think it does come down to, I mean, it's a bit of a cliche, but a tone at the top. But it's really quite true. I mean, if the company, the investment folks see senior management supportive of the legal and compliance effort, it trickles down. We have our CCO is a member of the investment committee as well, and that makes a big impact. But I think another thing, you'll be pleased to hear this, Tim, is the budget. We never feel legal compliance that we are handcuffed in using external resources, external counsel, or compliance consultants. Because I think that if there was a limit on our budget, that might be some tension.
That's great to know. That's the best news I've heard all day.
Did you really disclose that?
I mean, but as you said, I mean, it's you look at the the old, I don't know if people still use the Securities Act handbook, the big red book of securities laws, all the securities lawyers in the room. But I remember, when I started and practiced as an M&A lawyer, you'd see the Reg MA and the 34 Act and the 33 Act. Those are all thick parts of this, very unpleasantly large book. And then, but the thinnest part of it was the Investment Advisors Act. I mean, it's literally, it was like 14 pages or something very small. And it's grown a little bit since Dodd-Frank, but I mean, more of the growth has been in the rules, and way more of the growth, I think, will be in the enforcement actions and the examination pronouncements that we should all be reading. But I think what I want to echo here is that there's just a lot of uncertainty and a lot of just market practice as being an investment advisor. And where do you get that? You get that from going to conferences. The LPs talk to LPs. The hedge fund lawyers talk to other hedge fund lawyers. We call our outside counsel. That's how we learn how to operate. You always try to be above board, and you always wear your fiduciary hat. And a lot of the answering the question about what a fiduciary do, I find is oftentimes a common sense answer. You take the clean, the right approach. But there is a lot of discretion, and I think, just back to your question, I really hardly ever see tension with the senior business management side, and because look, the headlines scare people, and I feel like the insider trading headlines have died down a bit, but a year ago, that's all you could read in the paper.
But I like to believe it's not just headlines that are causing us as GPs, senior managers of funds to behave properly and do the right thing. And there's a few bad behaviors, right? But what keeps me between the lines is that's the way you should operate versus worrying about headline risk.
Right.
Well, and I think that's where some of the frustration from the business people come in, which is they truly believe, and they truly are trying to do the right thing. So being told that there are rules that don't necessarily make sense to anybody, when they fundamentally believe that they're trying to help their investors save for retirement or do the types of things that we all think are good things, the regulators, we realize, are there not necessarily for the 99% or the 95%, but the reality is we all have to follow the rules.
I thought I saw a hand up earlier. Someone have a hand up? Someone have a question? Okay, we can carry on. We've been talking about managers and regulators, and I think there's a tendency among lawyers in-house and in private practice to think a lot about that as a bilateral relationship. But I always like to think of it as a triangle, because not only can you have liability or conflict between a manager and a regulator, also with the investors. The investors are the other piece of the triangle, and looking at your liability, looking at your operational and other risks. So I want to move our focus away now from from dealing with regulators, talking about how you deal with regulators, to talk about dealing with investors. And for this, I want to kick off with Jeri. You went through a fundraising for your first fund. It was a very difficult time in the market. It'd be great to hear a little bit about that. In the last few years, what have been the big concerns or changes in the concerns that you've heard from your investors, maybe prospective investors you're teeing up for the future? What was that conversation like in 08, 09, 2010, and how do you feel that that's changing from your position?
It's interesting, I don't think it's changed a lot between '09 and now. There's a lot of things that are in place now, including ILPA guidelines and so forth. We're all really either in place or moving towards being in place by then. So all the, the doctrines, the philosophies. The last panel talked about alignment of interest, transparency. Those were key issues, which 10 years ago you might not have heard as much about. You certainly heard those. And I think as a new fund going out, we actually looked at what are those, ILPA standards, what are the key concerns behind that, and you recognize also as a new GP, as an emerging manager, you're kind of a terms taker, not a giver, right? It's kind of the first reality. So partly driven by that, partly driven by just it made sense to us. We're 100% management fee offset, so we don't have those conflicts, potential issues of which fees are offset or which fees aren't, and which accrue to us individually or towards a fund versus the LPs. Even if we charge a closing fee on the transaction or whatever, it's all part of that fee offset. We're also European waterfall, so it's not deal by deal. I mean, you don't get into the concern of we're collecting our money before again the LPs may be stuck, right? But we've taken money out. It's European waterfall, so they get all of their capital back plus their prep, and then so those kinds of issues.
And just to explain that for the audience, the U.S. approach in a private equity or any sort of closed-end fund has usually been what we call deal by deal, which is better probably phrased aggregated deal by deal. Every time you realize an investment, you're able to take a 20% carry off that, so off investment A, and then you add up A and B. When you realize B, you take it off there. The European approach is fund as a whole. You have to return all of the capital before you get any carry, so it radically pushes back into the life of the fund that the carry takes. And that's an interesting, we can talk about this if there are questions in the audience. A lot of times the U.S. is a market leader in terms, and we see the rest of the world adapting to that. This is a case where a lot of fund ones are taking on this very, very pro-investor deferral, really postponement of fees, of carried interest.
That's right. So I think those were key issues. And back office, I mentioned earlier, were key issues and continue to be even more so because of regulatory compliance. So otherwise, it's the standard stuff that doesn't matter. Team, track record, strategy, etc. Are all part of that. I think there's more of a keen awareness about if you're going to launch a fund, it's going to take a long time, no matter how good you are. Even if you're ultimately successful. And the cost to launching a fund, to be able to deal with, bringing in the right people and paying the right people in terms of outside expertise, and just surviving through that time period, it's an enormous, challenge. So I think a lot of new fund managers don't quite anticipate the extent of that, and I think that's kind of something that should be, because of all the rules you have to deal with now, and doing things the right way, and not to mention fundraising realities, it's something that needs to be more in the spotlight. I think becoming more in the spotlight.
You mentioned alignment of interest as panelists did on the earlier panel. I constantly get asked by new fund managers, people are thinking about starting up a fund. Well, what does alignment of interest actually mean? I hear this at the conferences. I put it on a slide so people, the investors know I really care about it, but what does it mean? And I always try to explain it to them that what alignment of interest means is if your LPs are sad, you should be sad. You should not be happy.
You should be sadder.
And if the LPs are very sad, you should be very sad. And I think that's what alignment means. We can talk about it in a lot of different ways about fees and offsets and results and how carry is paid out. But if your LPs are unhappy, you should not be happy. And that's the alignment, that's the security, particularly in a private equity fund, because you have liquidity in a hedge fund, but particularly in a closed-end private equity fund, they want to know that as the fates go up and down of the LPs and the GPs that they're in alignment.
But it isn't always so straightforward, because we were talking a lot about fees and carry and terms, the last panel, but here's a small fund, emerging manager, even if you're fund 2 or whatever, but certainly in the emerging manager category. Those fees, you don't get rich on the management fees, right? So that 2 and 20, if it's 2 and 20 for a private equity fund, we're not getting rich on those. I can choose one. It's certainly a dialogue that should be happening, and it's certainly there should be full disclosure. But I just think there's a difference between $1 billion fund or a $500 million fund and a $200 million fund, and having the full team in place, the right people that you need to pay, and the overhead that needs to be paid, and you should be getting rich on that. Certainly your incentive should be in the carry, right? Obviously, but it's a dialogue. It's a two-way dialogue. You have to be sensitive to the GP side, but we didn't hear that as much, I think, in the last panel. Not because they're not sensitive to it, just they're all LPs on the panel.
No, it's interesting, though, that you said first-time funds are term takers. They tend, the LPs, the potential investors, prospective investors, come with those. I also, again, explain it to first-time funds who are sitting in a conference room at my law firm. What you have to realize when you're going in and having a meeting, you're a first-time fund, you're going in and having a meeting with an LP who's experienced in this space, they're going to vent the frustration, all the things that they get pushed back on by the big boys, and I won't name any of them, the big boys, the big girls. This is now their opportunity. And I'm not saying this in any judgmental way. It's just the fact that negotiating leverage is radically in the favor of the investors. So oftentimes you'll find investors and LPs really pushing much more harder on terms with the first-time funds because that's where the optimal negotiating leverage is. And it can be difficult. It's difficult to raise a fund in almost all market cycles. But understanding how that dynamic changes between being a first-time fund or second or third fund, it's interesting to see how that comes across in terms.
And that 0% fee I heard about in the last panel, I mean, yeah, it's scary for a fund, new fund unless you have independent wealth going into the fund, right? Which is not usually the case.
I want to turn it over now to Charlie and Reena. Let me kick off with you, Charlie. PAMCO sits in a very unique position in the market. You yourself are an investor, your funds are investors in other funds, but you yourself are a fund that has to go out and find investors. How have you seen, wearing either or both of those hats, how have you seen the perspective of investors change kind of from 2008 today, either your own perspective when you were allocating or dealing with investors who were allocating to you?
Yeah, that's a good question. I take the first part, wearing the LP hat. And this is talking about liability with respect to investors. I think there's been a dramatic change in the last 5-6 years in terms of the rights of investors to negotiate terms that, and I'm talking about legal terms. We talked a lot about business terms in the earlier panels, but you took your classic hedge fund document, commingled fund document, which occasionally I see, although PAMCO hasn't invested in a commingled hedge fund in 3 or 4 years, I think. So, but they fly by my desk occasionally, and you look at the exculpation, the limitation of liability section, and it's invariably produced by 5 or 6 law firms, and Jim, yours is one of them. And invariably, it's the fund manager, their employees, GP, affiliated persons, and so forth, are not liable unless they are grossly negligent, willful misconduct, or fraud. And
that sounds perfectly reasonable.
right. So just to put, in layman's terms, they breach the agreement. They collect instead of getting a 20% performance fee, they inadvertently collect a 25% performance fee. Inadvertently, I don't know how that's not gross negligence, but imagine it's not. There wouldn't be theoretically there wouldn't be a cause of action for the investors to sue for breach of contract, which makes no sense. Why sit there and negotiate this document and hire lawyers and go back and forth and if you have no rights to enforce it as against the GP or the investment manager? So what I want to say is the rise of managed accounts, whether it's fund-to-ones, separate accounts. There's so many names and there's so many different ways to do it. And frankly, at PAMCO, we do 2 basic types of managed accounts. We do fund-to-ones, and we have a managed account platform where we're the advisor and we hire managers as sub-advisors, and we take care of much more of the infrastructure than the fund-to-fund. We dictate the terms of the legal documents. So just using that limitation of liability section, we have a list of 7 or 8 things, I believe, that we would hold the manager and the GP liable for, including, of course, a material breach of the agreement. And I think we're just seeing much more of that activity, both from our investors as well as when we face off against managers. And I think hedge fund counsel like your firm is you're much more receptive. You're seeing this as well. I think we have I think we have 2 right now with you guys, and they're much more commonplace. So I would encourage the LPs in the room to make that more the norm. They should be commonplace terms in hedge fund documents.
And is it commonplace in your fund documents when
Yeah.
you're talking to your investors upstairs?
Yeah, and then there's unique terms that the investors upstairs want, whether they're if they're a state public pension plan, they may have state fiduciary laws to which their managers are subject, and those will find their ways inside the documents. So they're very bespoke.
And Reena, what's your perspective on the tone or the tenor of investors in the last couple of years? What are you seeing at Wilshire?
I think they are getting more sophisticated and more interested in things beyond just the investment performance and the investment team. The previous panel was talking a lot about operational due diligence, and we have a hedge fund platform where we have smaller managers as well as larger managers, and operational due diligence is a very significant component now of what's going on. And the group that does the operational due diligence does have a veto over bringing a manager onto the platform. If they're not comfortable with a manager coming on board, we won't bring them on board. And that is in part due to investors just demanding not just a strong investment focus, but a strong infrastructure. And if the sub-advisor doesn't have that strong infrastructure, we can't really, we can't do much about that. So I think investors are concerned about infrastructure. They're very concerned about custody of assets and the flow of funds. So limited partnership structures I think are still very popular, but these managed account platforms seem to be increasingly popular because there's more certainty or comfort about where your assets are sitting, control over those assets, and investors are relying on the managers to ensure that those types of controls and safeguards are in place with respect to the funds.
Do you think that's an evolutionary step change, that we might be in the declining years of commingled collective vehicles, and in the future more and more and more will be allocated and managed on a segregated account or a funded one basis? Is that really, are we seeing the future now in that?
I don't see commingled vehicles going away, because you're still always going to have smaller investors who want access to types of investments that they couldn't otherwise get. But I think to the extent possible, they're looking for terms that are more similar to a separate account structure, a managed account structure. So what you're saying, gross negligence is no longer necessarily just, unless you commit gross negligence or willful misconduct, you're in the clear. They're looking for much more favorable terms.
And Tim, I would definitely echo that it is the evolution of hedge fund investing. And I just think back to my days when I was at Schulte, and I had one hedge fund manager client that got side letters at the end of each month, and we negotiate back and forth, and sometimes there would be expense caps in a side letter, which is kind of tricky, because you would normally want to, put the expense provisions in the PPM for all the investors to see, and no one can be charged to the fund. But I would always think, and this is being I was as the outside counsel. Well, we did the side letter; it's done. Now you hope the GC or the CCO or CFO, COO actually has a spreadsheet monitoring the side letter provisions and doesn't just forget about it and exhale and take the money and run with it. And maybe they'll miss that expense provision 2-3 years later. With a managed account platform, the managed account platform provider controls the cash wiring. So that the manager has no ability to pay itself or pay out an expense of the fund. That would all be controlled by the MAP provider. So that's a control above and beyond some 10-page side letter agreement that may be lost in a computer drive somewhere.
It's interesting, one of the largest public pension funds, which happen to be invested in our fund through a funded funds vehicle, just made an information request to all of their portfolio companies with some really, these are existing, not new kind of prospective ones, it took our CFO, who's really experienced doing this stuff, over a day, almost 2 days, to comply with this information request, which was another burden on the fund, but you do what you need to do for your LPs. But the level of granularity and the questions were not about our portfolio returns and things like that. They were on terms of the LPA and things like that. So clearly it was moving in a direction. They're going to want to monitor that more directly, or they're signing that, duty, if you will, to someone to do that. Because they have all the docs, but they want us to kind of feed into the system along with all their other. We know it's all their other because the funded funds told us. Everybody had to comply with that.
And there was a point on the earlier panel, which I just want to put now to you, Jeri, and Charlie, Reena, if you have thoughts on that. The barrier to entry, isn't that the most concrete view that we have, the new regulation, that the barrier to entry to start up a new fund? You give this example of a day and a half spent responding to one large query, but one query from one investor. How significant do you think those barriers to entry with all the new legal and other compliance in dealing with investors? Is it for real? Is it a significant barrier? Are we going to see a material decline in new managers? And then Charlie, what are your thoughts on that?
I think one of the panelists at the last panel mentioned they think there will be fewer funds. I think you said that. I think there'll be fewer funds that were never prepared to begin with. So they would probably been naturally weeded out, in my opinion. I think if you have conviction, you have the experience, and you're thoughtful about it, you know you're going to have those pieces in place. And there's definitely a cost to it. So that's where I was talking about the budgeting part of it, knowing it's going to take a while, what you have to pay for. And then the budget of even ongoing, I mean, our cost of compliance, right? Big cost of a full-time internal CFO. That's in the management company. That's not a fund expense. That's a management company expense. So, it has to be taken into consideration. So I think it's something that has to be more seriously considered. I don't know if it's, in my opinion, a significant barrier to viable potential funds.
Charlie, Reena, I mean, looking at both the demands from regulators and the demands from investors, how hard is it? You must see a lot of startup managers.
Yeah, and we primarily invest in emerging managers. Startups are under 500 million of assets, and I think I asked internally, and it used to be that these emerging managers had 2 or 3 employees at launch. Nowadays, it's more like 8 employees, and as I mentioned, if they're not having a full-time CCO day 1, they'll have it, day 2. They'll have it at $500 million.
We've still seen a couple of, I think it was somebody from the previous panel who said 2 guys or 2 gals in a garage.
Right.
We've still seen a couple of those, but they have an infrastructure behind them or institutional backing behind them. So they've got a certain level of assets that they know that they can kind of live off of in terms of managing until they're able to grow.
It's a big garage.
Not if you live at the beach. It's a really tiny garage. For example, on our hedge fund platform, you have to carry insurance. You have to have a compliance manual, a detailed compliance manual. We're looking for not just the compliance manual, but your processes and how you implement safeguards. And with 2 people, how do you have appropriate backup? How do you have appropriate checks and balances? It's really, really challenging. So
A lot of small private equity funds in our world, especially SBICs, they've been, when they first start, they outsource some of that to experienced providers, usually it's accountants who then work with the lawyers as well. But you still have to deal with it at some point. It's got to be part of your infrastructure.
We're a little bit over halfway our allotted time, so I just want to throw it out to any questions. Anyone in the audience have any questions based on anything that we've covered now? You think we've dodged an issue of materiality that you'd like to raise? Absolutely, and then we'll go
Jeri,
back after that.
Jeri, I have a question based on your last comment. It seems like the way you're describing this business model and the demands that a variety of investors are putting on funds, outsourcing would be almost the way to go, because otherwise, when you sort of think about it, you're spending everybody's spending a lot of time working on individual investors and spending a lot of resources on individual investors. Won't the model eventually sort of emerge in some way in which these demands will be captured kind of in a uniform way, and you will not have to spend as much time and resources on it?
Just to repeat the question, it really is focusing on the role of outsourcing, particularly in a new manager, and whether that's a direction that the industry will be going in.
Yeah, I mean, yes, I think, that outsourcing is clearly a viable way to handle some of that. You don't get the, I know you're going to talk about this later, but, this culture of compliance. It's hard to have a culture of compliance when you have somebody internally who's responsible for that at a senior manager level. Our CFO is a partner in the firm, he's on the investment committee, and I mean, he's not a lawyer, but he works closely with our outside counsel, so we are outsourcing that. We could outsource, more likely what you see some of the smaller funds outsourcing is the pure reporting side, right? The gap valuations, the third-party review of that. the general reporting and audit, you know, all that stuff that you can, there are firms that do all the financial back office part of it. But I think that's different than handling things that have to do with managing your LPs and the disclosures they need and the interactions they need and the compliance they need. That's not something, I think there's a risk of outsourcing that.
I mean, hiring an administrator is to some extent, I mean, which of course, you know, all hedge funds do, and you know, we want them to do, and a third-party administrator is a sense of, you know, is an outsourcing task to some degree. But you know, we would want our operations due diligence team would want the manager to shadow the books and records internally, and not just rely on the administrator's books and records.
It's probably different in private equity and hedge fund environments, so the answer might even be a little different depending on which kind of fund you are.
We had a question behind, yes.
Yeah,
If you could just give your name and who you're with.
Lily Steiner, American Business Gateway, and I work with a lot of entrepreneurs but I'm sort of getting really depressed listening to you guys. And
Sorry.
my question, well, no, because on the one hand, it's really understandable these onerous due diligence and compliance issues and everything. But on the other hand, I'd really like you to address what can be done to simplify and to make it easier rather than building on building on building, which is going to eventually take you to where everybody's crying out with the taxation department, let's just make it simple, you know, 999 or something. There's things that you've got to have, but it gets to a point where it gets ridiculously onerous.
I mean, I'll speak from the business end, not the legal kind of compliance, but, you know, I don't know if this will ever happen, but if the LPs can come up with, you know, a standard, at least for each asset class, like private equity, a separate one for hedge, whatever, when we have to submit our, you know, application, if you will, for lack of a better way, our diligence package, if there was a standard format to start that with, because every LP wants it in a different form and, you know, different level of granularity, and, you know, it'd be nice if all of that was somewhat uniform, and then obviously it goes from there because everybody has their own interests and areas to focus on. You know, I think that would be helpful. And similarly, you know, reporting. I mean, you know, the kind of reporting and things and formats we have to do with one LP isn't always the same as, you know, what somebody else wants. So we accommodate all that, but the more uniform it is, the better. I mean, generally, we're able to achieve that on the reporting part of it, but I think on the diligence part, that would be ideal from a GP point of view. Probably never happen.
I don't look at it as depressing. Well, I don't know. I'm not listening to myself, but you know, all these. I mean, look, it's also good work for a lawyer, so this is very self-serving. But the last 5 years, that there's been just a dramatic institutionalization of these businesses. And these are investment advisors are businesses from small to large. And I think, you know, it's going to be in an LP-friendly manner that in which these you know, rule changes take effect, and it should improve transparency. It should improve things that we care about, controls and valuations. So, I mean, it's been a bit of a painful growth period and an adjustment period to learn what these rules are. They're moving targets. AFMD is, you know, there's a lot of lack of clarity. But, you know, I think in 5 years from now, managed accounts will be much more. I predict they'll be much more common. People will know what they're doing. Terms will become much more standardized. And the rules of the road will be a lot clearer, but it is a period of transition.
I mean, yeah, there is a positive. I think you made a really good point. We're talking about some of the keep your, you know, the eyes wide open, the birds, etc. But there's a reason for it, and if it keeps the whole industry and the players in the industry, you know, aligned and clean from the SEC point of view, that's a good thing. We don't want bad actors because it negatively impacts all of us, as we're seeing in the news right now, right? So private equity is the evil something or another. It's not. There are some people that don't do it right, and there's others that do. So, you know, we don't look at it as this terrible thing that has no use. We just look at it as something we have to deal with, and there's a cost to it, and there's a burden to it, but there's a benefit to it.
I like the point about standardization, and I met with some of my peers in the industry a couple of months ago, and we were talking about standardization and documentation. I don't want to and this is a personal perspective, I don't think we should be winning or losing business based on whether we'll accept a gross negligence standard or a negligence standard. And I think most of us would agree that we're all willing to kind of play on the same field. So we should, to the extent that we can, try and find ways to be more standard or consistent in our documentation, and win or lose based on performance and strength of the team and fees and all those kinds of good things. And it will take those of us in the industry trying to work more together. So I was able to meet one of my peers from one of our other firms at this panel, and I'm hoping that she'll put me in touch with somebody at her firm so we can start talking about these types of things a little bit more and more formal, in a more formalized way.
So that would be great, right?
No, very good question, very good question. I thought I saw another hand. Any other questions? So the next item on our agenda is talking about lessons from recent litigation, enforcement proceedings, the things that have been in the headlines, and how we can build out from that. We were prepping for this meeting, this panel a couple of days ago, and a couple of really good ideas got thrown out. So we'll just pick 3 of them. We'll start with you, Reena. You mentioned a very, very interesting case, the Ranieri case. I don't know if you want to give the audience just a quick 30-second summary, and then we can talk about how the world of fundraising, actually getting money into funds, has really changed in some unpredictable way.
Sure. So Wilshire is an investment advisor. We haven't been a broker-dealer for a number of years. So the Ranieri case was of particular interest to me because it touched on placement agents and the regulators looking at an unregistered placement agent, but not only going after the placement agent, but going after the firm who hired the placement agent. Because the issue was settled, there was no new law made, but it kind of calls into question, when you need to be registered, when you're marketing your own funds, do you need to be a registered broker-dealer? There was then, I believe, a speech from one of the regulators that kind of took Ranieri and expanded on it and talked about an increased focus from the SEC on looking at unregistered activities and whether or not these sales agents need to be registered. So it's something we're very much watching very closely, and we're always kind of trying to figure out where that line is between being an advisor and being a broker-dealer, and if we need to be registered to do certain types of activities.
We have in the U.S. 2 different regimes that cover investment advisors and broker-dealers, 2 different sets of registration. And we've mentioned a couple of times on this panel that fundraising is difficult. It's not 2003, 2004, 2005. And one of the scary things, the particularly scary things about Ranieri is I've seen the contract, but I'm sure when the fund manager hired this would-be finder, there would be a rep in there saying you've got all the regulatory authorities you'll need, you'll be perfectly in compliance. And as someone sitting in Ranieri's position, or anyone who's raising a fund, you think that's the end of your analysis. They say they can do what they can do. You've asked the right questions, but to have liability come back on you, it's very hard to say no to money. And particularly when someone says they're going to go out and find you money. Do you have long-term concerns about this? Is this actually changing how you're operating internally?
I think there's always been that somewhat of a gray area about advisors and marketing your own funds and whether or not you need to be registered and commission-based compensation. So it absolutely is causing us to revisit these issues. We do have certain people within our organization who are registered with a third-party broker-dealer. That, I think, plus the Jobs Act and the new rules regarding advertising. I don't know about you, but I have not seen a huge wave of TV advertising on private equity funds. I don't anticipate that's going to start happening anytime soon. But I think all of these things combined make people start looking more closely at these activities.
Every time I see a George Foreman grill infomercial, I expect the next ad to be something about a hedge fund or private equity fund. It hasn't happened yet. I don't know, Charlie or Jeri, if you have any thoughts on fundraising and these issues about unregulated finders. Was that something that you came across, Jeri, when you were going out fundraising, people coming up to you to try to assist you with that, or did you do it yourself as far as going out and marketing?
We did it ourselves, but actually it was an interesting time when we went out because that was when the big private placement from the PE side agent scandal was breaking, and we were literally talking to pension funds who were the most sensitive to that issue, CalPERS in particular, so we decided not to use an agent. I mean, we were planning not to, but we were, had an open mind about it. Let's just put it that way. and felt that, that was just, because it created other consequences. So, but what's interesting is, the outcome of that, as many of you know, is that at least, in California, the agents have to be registered lobbyists now. So, but we actually had to sign a side letter with respect to agents, saying we didn't use one, or fully disclosing that we had used one, and the consequence if you breach that is about liability, right? If you breach that side letter, that agreement, then they can call their capital back, and that's obviously a terrible consequence. So the good news, we knew we can control that because whether you hire one or you don't hire one, it doesn't matter hiring one and then what they do if they do something wrong, which is a different issue. So it's kind of an interesting thing to deal with at the time.
A second big development, Charlie, you mentioned this earlier on about insider trading. Insider trading was in the headlines, front and center. It seems to now die down. Do you think that fund managers that you're dealing with or you're coming across, do you think they've learned all the right lessons from the insider trading cases? Do you think it's actually changed the way firms are operating, or it's just been a passing fancy by regulators and the industry is just slowly going back to where it was before? What's the legacy of all these high-profile prosecutions?
Yeah, I mean, it really hasn't changed the way in which we evaluate managers. I mean, our ODD team spends a lot of time looking at their compliance procedures, their personal trading policies, and their use of expert network firms, and digs deep in those areas. And it does depend on the strategy of the fund, of course. I mean, a fund that's doing fundamental research on companies has a different insider trading, profile than let's say a CTA or another strategy. But what I think that's interesting is that we were actually fielding a lot more questions, I think, from our managers and even from our investors on how PAMCO doesn't want to get in the middle of insider trading issues as well, because we get position level transparency from all of our managers, and we always have. And on our managed account platform, we get it on a T+1 basis. So we're getting, and this goes to something we said earlier about investors asking about your compliance policies and procedures, and we have to demonstrate, and we're proud to demonstrate how we protect that information and how we have a personal trading system that monitors our compliance and all the steps that we take, including in some cases providing quarterly certificates from our CCOs to clients, demonstrating our adherence to the code of ethics. So I mean, it's something that, but clearly after all those cases, it's something that everybody is just extremely vigilant about.
Final topic that we wanted to talk about, and Jeri, it's one that you've mentioned before on the panel, you mentioned on our call, is conflicts of interest. We've got private equity very much in the crosshairs of the SEC and enforcement officials and prosecutors of various stripes. What's your take on where the question of conflicts of interest stand now? Where do you see it going? What do you think is the focus that we should be having on this topic? Because it cuts across so many different areas of alignment of interest and compliance and just operating the commercial side of the business.
Yeah, I mean, that's an hour topic by itself, probably, especially with lawyers on the panel. But as a business person, we care about that a lot too, because we want to, again, walk between those lines. And I think the conflicts come in many areas. One, which has been obviously the subject in the press, is, fees, right, expenses and allocation, and what are you charging the portfolio companies, and then how those fees are being dealt with vis-a-vis your LPs. For us, on that topic, for example, we don't, with 100% management fee offset, that kind of takes care of most of it, but we don't charge it other than a closing fee, transaction fee. We don't charge ongoing fees to the portfolio company or investment banking fees. So that's more of a traditional, buyout private equity fund issue. But you see, but we partner in a lot of buyouts with other private equity funds, and primarily do sponsor deals. So we see all kinds of things, right? Mm-hmm. And some of them, are fairly aggressive about charging fees along the way, whether it's their management fees, monitoring fees, transaction fees every time they make an add-on, and that's part of what I think the SEC's been looking at. But to me, it's still a lot about disclosure, right? If you're upfront about it and everybody agrees to and understands it, then hopefully it'll be obvious if it's between the lines or not. I think the other conflicts we see, potentially co-investment, we have co-investments, we have either it's co-investment fund or just a bunch of LPs that want co-investments, and then how to manage that fairly and transparently, avoid those conflicts. And then since we invest up and down the capital structure, you can have conflicts between the various layers in the capital structure, because whether we're in the mezz, we're in the equity, we might have a partner that's, in some parts and not in others, and, that's not a new conflict, but it's one we're always dealing with.
Just wanted to go down to our fourth and final agenda item, which is just looking forward. And I'll put this question, the same question to all three of you. We've talked about increasing regulatory burdens, barriers to entry, and the like. Just to put it down on a human scale, if you had a friend, former colleague, old college roommate that came up to you today and asked you about starting a fund management business in 2014, 2015, how encouraging would you be? What words of wisdom would you pass on? What's your general thoughts to someone who's coming day one, fund one, to start up today? Let's just go left to right. Reena?
Is don't an answer?
Yeah. Perfectly that way.
Oh, if you'd asked me that question 20 years ago when I was first kind of working in this industry, I thought it would be the most interesting thing to launch my own fund. But today, I do still think it would be very interesting, and I very much admire what you're doing, but it's incredibly challenging, and the infrastructure that you need today is so much different than it was 20 years ago. So I think, the motto has to be simply be prepared. Know what you need to do, plan again, have contingency plans for costs and fees, and just realize that there's going to be a lot of work that you need to do. But I think it's an incredibly interesting industry and incredibly rewarding. So, if it's something that you want to do, I think there's still a lot of money to be made, which is always a really good thing. And two, it's still incredibly rewarding.
Counterpoint, Jeri?
Well, if I can do it, anyone can do it. I'm not. Part of it, I have had friends that come and said, you've done it, should I do it? And part of it, when I look at them, I think, are they ready? Forget about all the things which you appropriately mentioned, but do they have their thought process fully developed in terms of their strategy and how they're going to go out about doing what they're doing, and do they have the experience and the track record to do it? So first of all, are you going to even be able to check the boxes that are not dealing with infrastructure and all those things? And then if they do, they have that potential, then I talk about, well, assume it's going to take a couple of years, right? And assume you're going to need to have the team, or most of the team, already in place, and knowing how you're going to deal with reporting and compliance, and then make sure you keep your team in place, because when you're going through a couple of year process, potentially as a new fund, you have people who, you're not paying them full fare, right? You can't. A lot of people are, certainly people at the partner level are writing checks, not collecting, and then you want to have a couple of mid-level people potentially. We did. We were paying them, but not full salary. So, you can only keep the team together and motivated so long, right? So there are a number of funds that give up along the way. When we went out, there were a lot of people I knew that gave up, right? It took a long time. They weren't quite prepared for that, mentally or financially.
Tim, if I could add one thing to my previous statement, also know what your risk appetite is. Because I think, examining what your comfort level is with risk is so important when you're in this industry. And I'm sure that's a significant part of what you did when you were first starting out.
Yeah, we're talking about risk here. You're doing your own risk assessment. Can I get it done? What's the risk? And part of that's like everything we all do. We do our diligence. I talk to a lot of, friends who were, other GPs as well as some LPs, before we even launched, to say, does this make sense? We had a fully developed, strategy and plan. It's just, would it resonate, particularly in that time period? And, if you get the encouragement, and eventually you get some commitments, then you're on your way, hopefully.
It's too tempting to take off-the-shelf. I'm thinking now about the legal compliance world, but there's off-the-shelf compliance manuals, off-the-shelf documents. I think the best managers that I've seen take the time up front as a blank slate to customize the documents to their business, and it's hard to do because we just had that conflict of interest. It's easy to rely on formulaic language that says there are conflicts of interest. We're going to seek to mitigate, and let's forget about this document. But the hard thing to do is to pause and really think through and articulate what those are, because they are real conflicts of interest, and every business has it. And if you can clearly articulate it and tell your investors about it, I think there's, that just, it makes operating the business a lot easier. And then when the SEC comes in, you have a clean story, and that's really what they're looking for. They don't want to see that you pull something off the shelf.
That's an interesting point that we oftentimes advise on. I don't want to get into the relative levels of legality of not having a compliance book or having a compliance book and not following it. But there is a big difference between not having a compliance manual and having a compliance manual and not following it. When you don't have a compliance manual, you've made one mistake. When you have a compliance manual and you haven't followed it, you have given that 27-year-old examiner from the SEC who's flown in from the district office a roadmap to write you a 72-page comment letter of all the various ways that you failed. So it is, when you construct a compliance manual, I think I agree 110% with Charlie. Too many people who say, well, we'll just get something off the internet, we'll just buy something for $999 and just put it on our shelf and not have to worry about it anymore. That's causing an enormous amount of potential risks for the future. But with barriers to entry and costs going up, I'm not sympathetic, but I understand the thought process that gets new managers to think, well, we'll just cut corners here. When we've got 100 million AUM or 250 million AUM, we'll do it all better. But there is that temptation to, and it can be too late. Either your fund hasn't launched because good due diligence done by very, very able prospective investors have discovered that you just pulled this off some website. This doesn't apply to your business at all. Or you do launch and you come into serious problems very early on. One exit question: the subtitle for this year's private fund report was "A View from California." So I want to move away from talking about law and regulation, all of that, and just talk about how you rate the three of you, all based in California. We've got a group of great California-based investors here as well, so if they have any thoughts they want to chime in, please do. How do you rate California as a place to operate as a fund manager, to be in the investment management business? Let's start with Charlie and work back.
I won't say anything about the taxes, but no, I think actually I was worried a bit coming from New York, working at one of the big hedge fund law firms, that I would be a little bit out of the mix, particularly in Orange County. But really, the opposite has been the case. I think there's a benefit to being outside New York in some sense, that there's a lot of group thought in New York, and they're all talking the same thing and doing the same thing. And I think being outside the center of the hedge fund world gives you a little bit of an independent perspective, and I think it has allowed at least me to think a little bit outside the box in terms of how we approach hedge fund investing. So it's been a breath of fresh air.
Sure.
I guess we don't worry about too much from a regulatory compliance. I mean, that's kind of that we deal with that as it comes, but. I think it impacts in two ways. One is recruiting, right? So as we're adding people, because it's a lot harder to find, it's been harder, my colleagues all say the same thing in other funds, to find good people in California, unless you're lucky enough, and we were in a couple of cases where you have people coming from like New York, where they got a lot of their experience, and they have family out here, so they want to come out. But also because it's the cost of living is so much higher here than many other places, and taxes, right? So recruiting is an aspect of it. The other is just, we're always looking for good lower middle market businesses to invest in. Well, we invest around the country, but obviously being based here, we like to look right in our own backyard. And California's not very business friendly in general, so we're seeing a lot of those companies leaving, right? I mean, there's still plenty left, thankfully, but there's a lot leaving. So that would be the only other California folks. It's a great place to live.
When I moved here 6 years ago from Canada, I was worried that practicing in California was going to be so incredibly different and not having the training. And I will say that in this industry, I think because of the globalization of this industry, it was less challenging in some ways than I thought it would be. It's more about operating a business in California that's unique as opposed to operating an investment business in California. So I think with the globalization, it almost doesn't matter where we are these days. We have connections all over the world. We, like PAMCO, have offices in different jurisdictions. So I think the great thing is that you can almost put yourself anywhere. You can think about tax considerations and other types of considerations, recruiting considerations. You know, there are ways to do things globally, or things are much more global these days.
Optimistic notes, and I think we'll close our prepared questions, our prepared segments with that, and now turn it over. We have several minutes left for questions from the audience. If people do, just throw their hands up. We have a hand here.
Iman Abtawi, I'm a professor of law here at UCLA. We talked about activist funds, but we didn't talk about activist limited partners or non-managing members in your own funds. Do you encounter investors who want to be active, and how do you deal with them?
Very carefully. We have one family office investor, a very large one, and in addition to our other LPs, including banks, public pension funds. And that family office investor just likes to feel that they're much closer, right? They want to be more involved. They don't have ownership of the management company. They don't have, they're not a vote on our IC. But we meet with them more frequently. They have an observation seat on our IC to make them feel more comfortable, which they've actually pulled back from now. So, we just looked at what are their needs, can we accommodate that without limiting our own way of operating and making sure the rest of our LPs are comfortable with that. It's something we certainly disclose. That's the closest we have to activists.
Yeah, I would say part of the reason we moved to separate accounting many years ago was because of the governance risk issues we were facing in commingled fund investments. So, we're in the LP hat. We had some commingled fund investments that post the crisis, we had trouble getting liquidity out of the fund. We had trouble communicating with directors. There was just not a dialogue. There was no plan. There was no communication. So it's been frustrating dealing with the very few cases that remain in that commingled fund world. So that's been our to address that governance risk issue. We've moved away from commingled fund investing.
Yeah, we have a hand in the back.
Good morning. My name is Mike Manahan. I teach entrepreneurial finance and accounting at California State University Dominguez Hills to the fund managers of the future, hopefully. But I also serve as a member of the Downtown Long Beach Economic Development Committee. And we have been discussing the possibility of starting our own fund for the sole purpose of fueling the economic growth in downtown Long Beach. And my question to you do you have any advice for myself and the fellow members of my committee in an exercise of that nature?
And is that a public body or a private body?
We are actually a nonprofit organization that supports economic development in downtown Long Beach. However, the concept was to produce a for-profit fund and solicit investment into that fund, but solely for the purpose of supporting businesses in downtown Long Beach.
Well, I think at least half startup managers are unintentionally nonprofit. So, any thoughts from the panel on a unique but interesting strategy such as that?
I mean, I would imagine that I've heard about similar efforts elsewhere, so my first advice would be to find other people who've already done it and learn from their mistakes as well as their wisdom. There's a lot of state funds. Your geography is pretty small relative to what you're trying to achieve as far as an actual fund itself, so that might be a challenge. I mean, because even state funds, there's a number of, Michigan has that and so forth, that focus how they help raise funds or invest, actually public pension funds or invest in GPs that only invest in that state. And that's, from a risk diversification point of view, that has its own obvious downside, but it doesn't mean it can't be very well done, and it has been very well done.
You might see yourself along that line more a recipient of funds that might have regional or statewide and be more focused on allocating. Managing a fund is a question of scale. And a person who gives you money for a fund one, and say your fund one is $1 million, not $1 million, $50 million or $100 million, a lot of LPs will only make that initial investment if they can see you getting to 250, 500, 750. They're going to do this due diligence if there's a long-term commitment to write really big checks in the future. And as many good nights out as I've had in downtown Long Beach, it would be an interesting proposition to develop, whether or not there's that scale in that market. But there might be other sources of capital or other people you could partner up with. But very, very interesting question. Other questions? I saw a couple of other hands on the floor. Either for this panel, we have a number of the panelists from the prior panel sitting quite conveniently as well.
I'll go there.
Yeah.
Obviously, the question's focused on credit. And this carried interest group was always.
Maybe give the microphone.
No, speak up, or repeat the question.
You want to use the microphone?
As a tax lawyer, you'd be surprised to know I have a tax question. I've followed the carried interest rule for some time now. I know that Congress has tried several times to treat it as it should be treated, as ordinary income. And the profession has always stood up and said, no, we need it, and it would be very damaging to our business in general if you took away its favorable tax treatment. Can you enlighten me a little bit more about where the industry stands on that?
Yeah, Tim.
I don't know if I really should be the one leading off the answer to this question, although I fully appreciate the nuances of that. I don't know, do either one of you want to take a stab at it, or should I go?
I've been supporting managed accounts all day. I'll fit that in. I mean, in most managed account structures, you're paying a performance fee. You're not setting it up in you may not set it up as an LPGP where you can do an allocation. So I think a fee would be characterized as ordinary income. So you get a win-win with a separate account on that front.
But although most of the separate accounts, correct me if I'm wrong, are going to be hedge funds, not private equity vehicles, because you're not going to get a performance fee on a real-time basis in a private equity vehicle, are you?
You're not going to get a performance fee in a real-time in a private equity.
In a private equity vehicle, it's going to be over time. So.
Yeah, I mean, but we had managers that had long-term capital gains in their strategy that if they had an allocation, they would have a preferential fee. A preferential tax treatment.
It goes back to alignment of interest, really, because the history, I believe, is trying to align the interests of the investors with the interests of the general partner or the manager. And to the extent that takes away from the alignment of interest, I think even the industry, not necessarily just the general partners who are benefiting from it, would have concerns with that. So I think the industry generally wants to see that.
I've got a couple of thoughts that just popped in my head as you were asking the question. I think it's important when we talk about the carried interest tax debate to define terms and get an understanding of what the current situation is. You mentioned a carried interest tax rule. The reality of the situation, I would contend, and you're a tax lawyer and I'm not, but I've spent a lot of time thinking about this and people have been explaining to me the history of how we got to where we are. It's important to understand that almost without exception, no hedge fund earns carried interest tax treatment, almost without exception. And the reason that is we don't have a carried interest tax loophole or a carried interest tax rule. We have two rates of tax. For some reason, for the last 100 years, say for a couple of years in the mid-'80s, we've had a bipartisan agreement that there should be a rate of income tax for ordinary income, and there should be a rate of income tax for capital gains. Bipartisan agreement seems to have done well over the last century. What carried interest does is take the very public policy motivations that stand in favor of having a lower capital gains tax rate and simply apply that through established partnership accounting, the operation of capital accounts. We have the name carried interest. Carried interest, the interest in the underlying cash flows are being carried over in the capital accounts, because the fundamental point of partnership taxation is a partnership doesn't exist. Partnership doesn't exist. Whatever comes into the partnership leaves the partnership pro rata based on your partnership percentages. If what lands in your hands in a hedge fund is ordinary income, because it's trading profits, you bought and sold shares of Apple in the same day, that tax treatment is passed on to the investors. If what you receive in your hands is capital gains, then that capital gains is passed on. I've always thought that the more interesting question is, do we really believe in two rates of tax? If we really do believe in two rates of tax and the public policy behind that, then the function of a private equity fund partnership is to deliver precisely those long-term capital gains. Now, if we say no to carried interest, we're probably saying no to a capital gains tax rate as well. It seems to me all partnership accounting does is make that transparent. Now, if we have issues, we want to have higher tax rates, we want to change the tax rates, I personally believe all that's on the table for public debate, for Congress, for all the instruments of democratic process to deal with. But the carried interest situation that we're in, and we came across quite an interesting Congressional Budget Office attempt to summarize the state of the debate now. And it was very clear, again, from the CBO, that what we have here is the application of tried and tested partnership law principles to the fact that we have two tax rates. Carried interest didn't invent a second tax rate. If you flip through the tax code, there's not a carried interest loophole section that says, and oh yes, carried interest will be taxed at a lower rate. It's an application of two very, very basic concepts, but it's a political debate. And I personally believe that the political debate around our fiscal system should be open and vibrant and all of that. But I think if we deal with this, we have to deal with it in the context of a body of partnership law and a body of a concept, a bipartisan century-long concept that we should be taxing capital gains at a lower rate. I'm sure at least one person here will want to write a response or a comment on my remarks. Anyone? Or you?
First, you're taking the concept of sweat equity and you're treating it in the same manner as you would a capital investment. And because you allocate 20% of the partnership to the people who manage it, does it make that the same creature as the capital equity of people who put in money? It is sweat equity. And in every other section of the law, when you have sweat equity, even if you have that equity for a long time, you don't get capital gain treatment, you get ordinary income treatment. And that's the issue, not whether you call it a special loophole or something else.
But, and all I can comment on that is 2 points. My understanding of the sweat equity rules is that specifically relates to share ownership. That's a regime that goes around share ownership, and I think it's a specially constructed regime for that. What I'm talking about is really 2 things. General principles of partnership law. General principles of partnership law and how partnership capital accounts are taxed, rather than going into the weeds and saying this has to comply, because it's not, as I understand, carried interest structures are not meant to comply with those very, very specific rules. And then I have to put my hand up and say my other observation is we have 4 decades of IRS practice, which maybe should be changed. But we have 4 decades of IRS practice, and that probably means something somewhere in the analysis. But if this is a question, a political question should be answered politically, through our representatives in Congress and the people that have strong opinions on that. But I think it's a vital question. My final observation on this is the sums are not significant. If you look at the state of the federal budget, you look at other ways taxes are collected, we're not talking about all of a sudden next year our budget will be in balance. We're talking about sums of money that wouldn't significantly move the needle from a federal budget point of view. But on the other hand, do the arguments behind the capital gains tax rate, do we believe in them? Do we believe in them? If we believe in them, then we might want to think about what other good types of investments that sort of ideology or those sort of beliefs foster. Other opinion? Your follow-up opinion? Other opinions? This is probably one of the most contentious debates in and around the area. Just the person behind you.
But in the popular mind,
Yes. Yes.
The layman's view,
Yes.
is preferential treatment.
To a handful of people.
Yes.
That if LeBron James has to pay tax.
That's the political problem.
Yeah.
That's the political
Perception.
problem.
It's a perception problem.
Preferential treatment in the popular mind.
Yes. Oh, I agree with that completely. And if the private equity industry, I'm speaking in a wholly individual capacity, if the private equity industry feels that this is necessary in order to maintain the industry, and the industry is producing you can wrap yourself up in the American flag, and the industry is doing a good service for all concerned, then that needs to be conveyed. I think we're still in all the alternative areas, whether it's hedge funds, mezz, real estate funds, private equity, venture does a great job. But I think a lot of the other industries don't do a very, very good job of getting that point out. This works for us. One, because we explain the mechanics of it, but the moral argument, which you're right, is completely separate. The moral argument is we deserve this because we foster growth, we foster economic rationalization, we ensure that there are long-term security for jobs. We have all these other services. So I think there's a larger, and in some ways our report and our conference here today is a way of providing that forum here very much in a California context for people to talk about those issues, which I think are very important. Any other thoughts on that, or any other comments of a legal or political nature?
Let me follow up your comment.
Okay. Let me just put, just 1 second, I'll go to you as a closing point. Anyone else want to throw a hand up here? And okay, we've got one here, and then we'll go to you as an exit point.
Just we're going to talk about voting, way people vote in their own nature, why they believe people should have preferential treatment. I just want to make a comment that in the wake of Citizens United, that's going to be a much more complicated debate, because now the money talks about one vote, one person. And so when you talk about preferential treatment, people have money, I can only anticipate that they will continue to extend that preferential treatment.
Any other questions, any other thoughts? You've got lunch outside? Then
The only thing I would mention, I didn't want to get in the debate. I mean, obviously, we're receiving carried interest and want to have it be taxed as capital gain, but there's a whole debate, and I'm not going to try and represent my industry in that regard. But I think the point is, what we have to give some thought, if it does pass, right, where it's going to be converted to ordinary income, which is probably more likely than not, what's the impact on, private, from my perspective, private equity industry? Because that's that's the biggest incentive we have. That's how we're, partly how we're paid, and that has implications. Then as we can restructure this, the compensation system of the industry, or just, and maybe not. Maybe it's okay as is, but it's something that has to be thought through. So that I'll just talk about the follow-on rather than debate the.
That's fine. Any other questions? And then we'll break for lunch after these closing remarks. So, final point.
You mentioned the difference between corporations and partnerships. In a corporation, if you get sweat stock, you can pay tax at that point on the value of the stock because you haven't paid anything and you receive something of value. If you make the election and pay tax at that point, any further increase in the value of that share is capital gain, but not that first part. What the problem with carried interest is that there has never been any equity purchase. You've never said, I'm receiving 20% or whatever percent it is of this partnership, and I'm not paying anything for it. If you take the value of that 20% at the beginning of the partnership, at the beginning of the investment, you pay tax at ordinary rates on that value that you receive for no capital. Then I would agree that any gain in that 20% over the period of the partnership ought to be capital gain. But that's a different kettle of fish.
We've got a hand in the back.
It's all structured. If I start a fund, and it's my fund and I own 100%, and I sell out 70, I have zero basis, and I have 30%.
Yeah, I'll just repeat.
If it's very simple, if you're a tax lawyer, you just say, what's my goal, and you structure it to it.
And name and where you're with?
I'm Ellen Batesel. I'm a tax lawyer by training, but I now have my own company.
Fantastic. I would only make the comment that on day one, the value of the partnership is known. And the Inland Revenue, now HMRC in England and Britain, does a much more detailed explanation of how they got to the same position we're here now. I'm conscious of time, and I want to leave with just one final remark on this that I won't put it out to survey, but I'll just put it out to question. If we change the tax treatment on carried interest, and we tax it fully as ordinary income, and we assume that there's a wide, broad consensus for that, what will the rate of carried interest charged in a private equity partnership be in 5 years? Do you think it will still be 20, or do you think it will go up magically to a number that is the effective post-tax income of the old rate? That's a difficult question to have to answer. But I'm more than willing to carry this conversation on afterwards. I want to thank you so much for your patience. We're a couple minutes